Reading 27, Risk Management of CFAI's 2018 edition. Summary. Financial markets reward competence and knowledge in risk management and punish mistakes. Portfolio managers must therefore study and understand the discipline of successful risk management. In this reading, we have introduced the basic concepts and techniques of risk management and made the following points. Risk management is a process involving the identification of exposures to risk, the establishment of appropriate ranges for exposures, the continuous measurement of these exposures, and the execution of appropriate adjustments to bring the actual level and desired level of risk into alignment. The process involves continuous monitoring of exposures, new policies, preferences, and information. Typically, risk should be minimized wherever and whenever companies lack comparative advantages in the associated markets, activities, or lines of business. Risk governance refers to the process of setting risk management policies and standards for an organization. Senior management, which is usually ultimately responsible for all organizational activities, must oversee the process. Enterprise risk management is a centralized risk management system whose distinguishing feature is a firm-wide or across-enterprise perspective on risk. Enterprise risk management is a centralized risk management system whose distinguishing feature is a firm-wide or across-enterprise perspective on risk. Financial risk refers to all risks derived from events in the external financial market. Non-financial risk refers to all other forms of risk. Financial risk includes market risk, which is risk related to interest rates, exchange rates, stock prices, and commodity prices. Financial risk also includes credit risk and liquidity risk. The primary sources of non-financial risk are operations risk, model risk, settlement risk, regulatory risk, legal risk, tax risk, and accounting risk. Traditional measures of market risk include linear approximations such as beta for stocks, duration for fixed income, and delta for options, as well as second-order estimation techniques such as convexity and gamma. For products with option-like characteristics, techniques exist to measure the impact of changes in volatility and passage of time. Sensitivity to movements in the correlation among assets is also relevant for certain types of instruments. Value at risk, or VAR, estimates the minimum loss that a party would be willing to experience within a given probability over a specified period of time, using the complementary probability, i.e., 100% minus the given probability stated as a percent. VAR can be expressed as a maximum loss at a given confidence level. VAR users make decisions regarding appropriate time periods, confidence intervals, and specific VAR methodologies. The analytical or variance-covariance method can be used to determine VAR under the assumption that returns are normally distributed by subtracting a multiple of the standard deviation from expected return, where the multiple is determined by the desired probability level. The advantage of the method is its simplicity. Its disadvantages are that returns are not normally distributed in any reliable sense, and that the method does not work well when portfolios contain options and other derivatives. The historical method estimates VAR from data on a portfolio's performance during a historical period. The returns are ranked, and VAR is obtained by determining the return that is exceeded in a negative sense, 5% or 1%, depending on the user's choice of 5 or 1%. The historical method has the advantage of being simple and not requiring the assumption of a normal distribution. Its disadvantage is that accurate historical time series information is not always available. particularly for instruments such as bonds and options, which can behave differently at different points in their lifespans. Monte Carlo simulation estimates VAR by generating random returns and determining the 5% or 1%, depending on the user's choice, of the worst outcomes. It has advantages that it does not require a normal distribution and can handle complex relationships among risks. VAR can be difficult to estimate, can give a wide range of values, and can lead to a false sense of security that risk is accurately measured and under control. VAR for individual positions do not generally aggregate in a simple way to portfolio VAR. VAR also puts all emphasis on negative outcomes, ignoring the positive outcomes. It can be difficult to calculate VAR for a larger, complex organization with many exposures. On the other hand, VAR is simple and easy to understand and is widely accepted. It is also adaptable to a variety of uses, such as allocating capital. Incremental VAR measures the incremental effect on an asset of the VAR portfolio. Cash flow at risk and earnings at risk measure the risk to a company's cash flow or earnings instead of market value, as in the case of VAR. Tail value at risk plus the expected loss in excess of VAR when such loss occurs. Stress testing is another important supplement to VAR. Credit risk has two dimensions: the probability of default and the associated recovery rate. Credit risk is a forward contract assumed by the party to which the market value is positive. The market value represents the current value of the claim that one party has on the other, but the actual payoff at expiration could differ, but the market value reflects the current value of that future claim. Credit risk in swaps is similar to credit risk in a forward contract. The market value represents the current value of the claim on future payments. The party holding the positive market value assumes the credit risk at that time. For interest rate and equity swaps, credit risk is the greatest near the middle of the life of the swap. For currency swaps with payment of notional principal, the credit risk is greatest near the end of the life. Credit risk in options is one-sided because the seller is paid immediately and in full. That person faces no credit risk. By contrast, the buyer faces the risk that the seller will not meet their obligations in the event of exercise. The market value of the option is the current value of the future claim the buyer has on the seller. VAR can be used to measure credit risk. The interpretation is the same as a standard VAR, but a credit-based VAR is more complex because it must interact with VAR based on market risk. Credit risk only arises when market risk results in gains to trading. Credit VAR must take into account the complex interaction of market movements, the possibility of default, and recovery rates. Credit VAR is also difficult to aggregate across markets and counterparties. Risk budgeting is the process of establishing policies to allocate the finite resource of risk capacity to business units that must assume exposure in order to generate a return. Risk budgeting has also been applied to allocation of funds in investment managers. The various methods of controlling risk include setting exposure limits for individual counterparties, exchanging cash values that reflect mark-to-market levels, posting collateral, netting, setting minimum credit spreads, using special purpose vehicles that have a higher credit ratings than the companies that own them, and using credit derivatives. Among the measures of risk-adjusted performance that have been used in a portfolio context are the Sharpe ratio, risk-adjusted return on capital, return over maximum drawdown, and Sortino ratio. The Sharpe ratio uses standard deviation, measuring total risk at the measure. Risk-adjusted return, start that one over. Among the measures of risk-adjusted performance that have been used in portfolio context are Sharpe ratio, risk-adjusted return on capital, return over maximum drawdown, and the Sortino ratio. The Sharpe ratio uses standard deviation, measuring the total risk as the risk measure. Risk-adjusted return on capital accounts for risk using capital at risk. The Sortino measure measures risk using downside deviation, which computes volatility using only rate of return on data points below minimum accepted return. Return over maximum drawdown uses maximum drawdown as the measure. Methods for allocating capital include nominal position limits, VAR-based position limits, maximum loss limits, internal capital requirements, regulatory capital requirements. Let's go through these formulas real quick on 6.3. Sharpe ratio, mean portfolio return minus the risk-free rate divided by the standard deviation of portfolio return. The Sharpe ratio is the mean return earned in excess of the risk-free rate per unit of volatility, or total risk. Risk-adjusted return on capital. This concept divides the expected return on investment by a measure of capital at risk. A measure of the investment's risk that can take a number of different forms can be calculated in a variety of ways that have appropriate proprietary features. Return over maximum drawdown, ROMAD. Drawdown in the field of hedge fund management is defined as the difference between a portfolio's maximum point of return, known as the high water mark, and any subsequent low performance. Max drawdown is the largest difference between high water and subsequent low. Max drawdown is a preferred way of expressing the risk of a given portfolio, particularly as associated track records become longer for investors who believe that observed loss patterns over long periods of time are best available proxy for actual exposure. Return over maximum drawdown is simply the average return in a given year that a portfolio generates expressed as a percentage of this drawdown figure. It enables investors to ask the following question: am I willing to accept an occasional drawdown of X% in order to generate an average return of Y? An investment with X% of 10% and Y of 15% would be a 1.5 ROMAD and would be more attractive than an investment with a drawdown of 40 but an average annual return of 10 would be a ROMAD of 0.25. Sortino ratio. One school of thought concerning the measurement of risk-adjusted returns argues, with some justification, that portfolio managers should not be penalized for volatility deriving from outsized positive performance. Sortino ratio adopts this perspective. The numerator of the Sortino ratio is the return in excess of minimum acceptable return, MAR. The denominator is the downside deviation using MAR as the target. Downside deviation computes vol using only rate of return. So downside deviation computes volatility using only the rate of return data below MAR, the minimum acceptable return. Thus, the expression for Sortino ratio is Sortino ratio equals parentheses mean portfolio return minus MAR, minimum acceptable return, parentheses ends, divided by downside deviation. If MAR is set at the risk-free rate, then the Sortino ratio is identical to Sharpe ratio, save for the fact it uses downside deviation instead of standard deviation as the denominator. Taken together, the two ratios can tell a more detailed story of risk-adjusted return than either will in isolation, but the Sharpe ratio is better grounded in financial theory and analytically more tractable.